Some of the most successful investors over the last 30 years have been boring. Deliberately, stubbornly boring. And that's exactly why it worked. Now, I've seen firsthand and have plenty of experience of watching this happen in real time in my experience as a chartered financial planner. I want to tell you some stories about boring millionaires and what this looks like in real life. You may have seen in the news recently, or you may not have, or it might have popped up in your feed, around the emergence of ISA millionaires. Now, I know a couple of ISA millionaires. I have one or two clients who are ISA millionaires. And essentially what this means is people who have £1 million or more inside their ISA. Now, you won't find any ISA millionaires who simply have cash ISAs. That's not possible. When ISAs were introduced in their current form in 1999, those that maxed out their allowances every single year, right up until this current year, will have approximately contributed around about £330,000, £340,000. So how did they get to £1 million? Well, the ones I know anyway, were simply methodical, boring investors. The skill was not in their trading or their investment choices. The heavy lifting was done by the compound interest year on year. Each year that their money grew, the growth had a larger effect every single time. It comes back to a key principle of mine when it comes to investing for my clients, which is boring over flashy. Now, you may have seen videos on Instagram or on TikTok from someone talking from a sunny hotel or in front of their yacht trying to explain how brilliant their trading strategy is. Maybe it works, maybe it doesn't. I don't know. What I do know is this strategy works. I've seen it over and over again with my own clients. So for me, this is evidence-based, and I'm speaking from experience when I tell you that these are the things that real people have done to build themselves genuine generational wealth. One of them is leaving it up to the markets or to investment specialists to build their wealth for them. Involvement is at an absolute minimum apart from their regular, consistent contributions, whether that be into their stocks and shares ISAs, their general investment accounts, or into their pensions. Now, there have been occasions where, and there are still quite often conversations I need to have with clients around not involving their emotions in this investment journey. And every time that there is something going on in the world which is fractious and creates uncertainty and shakes the markets, we've recently gone through the situation in the Middle East. Prior to that, Russia invading Ukraine. Prior to that, COVID. All of these things have an impact on markets, which ultimately reverberates through everybody's investments. During COVID, I had a client who was not too far away from retirement and completely understood the panic, but they were very much questioning why we weren't selling from the portfolio and leaving it invested. Well, I had to remind him why he firstly invested, what the purpose of his investment was for, and there were a number of conversations I had to have with him to reassure him that the only way to actually crystallize this loss that he was seeing was to do exactly what he was asking me. If we were to do that, then we would have been trying to time the market. His point was that he felt like his portfolio was going down every day. We didn't know what the outcome would be, and he wanted to reinvest when things had calmed down. And as we've covered many times in other videos, the best performing days in the market are often just after the worst. So it's during those recovery times that you need to be participating. And to that end, you have to participate in the downturns as well. So time in the market is what's going to beat trying to time the market. Yeah, not all my client stories are as dramatic as that particular COVID incident, but I've got a number of clients who over the last 10 years have simply paid what they can into their stocks and shares ISA, paid what they can into their SIPs. I've never drawn money out. The ones I'm thinking of are still working, so it's something that for them, they just don't need to think about. It's in the background. It's doing all the heavy lifting for them. It's boring to them. It doesn't really impact their lives whatsoever. But that money is working really hard for them. It's compounding year on year. And I can think of a number of clients off the top of my head who've been doing that for so long now that they could retire today. They only work because they still enjoy doing it. But they've built up hundreds of thousands, some of them millions of pounds inside these investment accounts. It's really easy to get sucked into all of the noise, whether it be on the news or on social media. But the real enemy to your returns over time isn't that volatility, it's not that noise, it's your reaction to it. And the more that you can take a hands-off approach, leave it in the background, keep it as boring as possible, the better chance you're going to have of building yourself long-term wealth. It's very easy in today's world to feel like you're not doing enough. Everyone's trying to convince you that you should be doing this, you should be doing that, you should be taking these steps. But actually, you should be focused on being patient, low cost, staying invested. This is what builds wealth over time. And they require almost no effort to execute.